Portfolio Builder's top selling advisory is now up 33% total return in 2022. And we've done it with 3 stocks. We're recommending investors pick up these 3 critical stocks to protect your wealth now. And again, most investors have been really having a rough year. We have seen the stock market jump back up, but there's been a lot of volatility. The same strategy returned 233% in 2021. We did most of that year with only 4 stocks. What I'm going to cover right now is the trade alert. If you're on a free trial or a paid customer, this is what we're recommending in our high risk portfolio for every $10,000 invested. Step 1, buy your stock crash insurance, 68 shares of UVXY. Now, UVXY returned 1,100% in the lockdown of 2020 when the S&P 500 fell 34% in just under a month. So a 10% position in UVXY can completely protect your portfolio against a 90% drop in your stock portfolio in the event of a mega crash. Here's a look at the UVXY product this year. For a small period of time, it was actually up 80% year to date. That did fall back down. But when the volatility was entering the market, our clients weren't feeling nearly as much pain as most investors because of this critical hedge. Now, we don't like to penny pinch profits on UVXY. It's really there for an absolute catastrophe in markets. So unless we see an absolute shock, we rarely touch that UVXY position. Step 2, pick up 170 shares of our favorite growth asset. This is stock ticker ETHE. It's from the Grayscale Trust. It gives you exposure to Ethereum. Now, this has jumped another 10% from this screenshot, so it's up more than 21,000% since 2017. Now, again, we like the Grayscale Trust because you can buy it in your stock brokerage account, ticker ETHE. Now, what is Ethereum? It is essentially replicating the entire financial system on DeFi. So it's just a massive growth opportunity. We say this is like getting into really into Microsoft when it's 5 years old. They really have a operating system to design software that's decentralized. Step 3, buy 76 shares of Boyle. Now, Boyle's been a massive returner for us this year, up 81%. And the truth is this could go up substantially higher. Europe's currently rerouting its natural gas purchases to not come from you-know-who, and they think this is going to take a year or 2 to achieve. So as long as the conflict remains, this is going to be a really smart hedge. So we are long Boyle, which gives you exposure to natural gas. So not only can Europe drive these prices up higher by trying to reroute all their orders to North America, if the conflict escalates, Mr. P could easily use it as a war tactic and shut off natural gas to Europe, and then that's lights out, no electricity for Europe. If we look at the table, we have the breakdown like this. This is in your email every day. 68 shares of UVXY on the defensive side of the portfolio. So this is typically deflationary assets we put in the red shaded area. Right now, it's 9.5% of your portfolio. Then we have 170 shares of ETHE. This is your growth asset. And again, this is the fastest growing technology in history in terms of user growth. It's growing faster than the internet did, and it's in its infancy. We plan to hold this asset probably for the next 25 years before expecting it to really hit its premium valuation. And really, the whole strategy is designed about how to protect that single position against its risks. And again, we're going to say stock crash is critical to hedge against, and then inflation. So Boyle is your inflation hedge, and you're coming in at 76 shares. So the breakdown is about 10% in the crash insurance, 48% in your growth asset, and then 42% in your inflation hedge. Now, the game plan is, soon as we see the conflict simmer down and probably some sort of diplomacy occurring. We want to dump, boil, and we want to add to Ethereum or FNGU. That's the new play we're excited about. So sell UVXY, add to ETHE, and then throw in FNGU. FNGU gives us 12 top tech companies, 2 out of China, 10 out of the US, that have been really beaten up this year. So extreme opportunity ahead for FNGU. Now, once again, here's your Ethereum chart. We've had a 50% pullback and now it's rebounding. And it's a beautiful time to go long that play. Here's a look at FNGU. This thing got just clobbered, just absolutely clobbered. But now I think we're nearly at the point, probably within the next 30 days, where I'll pull the trigger, we'll dump boil, and we'll get a massive position in FNGU. And I do see this going to new highs this cycle. And so why is the conflict ending important? Because it's going to reduce inflationary pressures and it's going to ease the Federal Reserve to not be so crazy with all these rate hikes they're talking about. My expectation is once the energy costs start to fall, you're going to see tech and crypto melt up and the dollar index start to cool off. So the returns we're making right now with the dollar going up are just incredible. The second the dollar starts to fall, the profits are going to be that much more impressive. And so here's a look at that cost of oil, just at nose-bleeding prices. And so this is unlikely to last very long. And so that's why it's very important we get out of our energy plays at the right time. This has been overdone. We made investors a ton of money on NRGU last year and then boil this year. And again, I think we're on the verge of the exact opposite play, making money. Okay, so growth outperforming value. Here's the 20-year treasuries, just getting the wind knocked out of it. TLT today is bouncing. Biden's released a new $6 trillion spending package, so markets are enjoying that. And so once again, TLT above 125, I'm okay with. If we see TLT go to 125 or below, I do believe it will collapse the financial system. So that's one red line I'm carefully monitoring for you. We'll look at bond yields in a little bit. Here's that 2-year bond. This thing just keeps going up. So yeah, this has been very overdone in the bond crash. And I think we're on the verge of, again, easing in the bond market, which will be very bullish for how we're positioned. Here's that DXY, also way overdone to the upside. And I think we're going to have some dovish surprises this year, soon as energy costs come down. Now, the last time the US was in a tightening cycle, while China was expanding credit, 2016 to 2018, Bitcoin returned 4,400%. So that's what we've been predicting would be the general case for markets this 2-year stretch. And so far it's playing out really beautiful. So that is very exciting as we continue into 2022 and beyond. Cash globally is trash. Every government is running massive deficits. They're spending more than they make. And bonds remain in trouble. The inflation's greatly over the interest rates. And now we're selling into the market about $2 trillion of debt a year between quantitative tightening they're talking about and just our normal budget. So the bonds will crash until those interest rates get too attractive. Again, we know some levels that'll be critical to make very important changes to the portfolio. So for now, investors still have no other logical option. We've just been beating this same drum line over and over again, and it's working really well for our clients. Until bonds are attractive, you want to be long stocks, cryptocurrencies, and commodities, and expect a melt up until that magic moment occurs. And again, we really need the CPI to fall towards those yields for bonds to become attractive. That's not going to happen until these energy costs come down. Now, the longer this conflict persists, the longer the bond market's going to remain ugly and continue to force investors into the exact assets we're recommending. So make sure to watch our webinar every Monday, Wednesday, Friday, and be ready for critical sell alerts. If you want to upgrade your portfolio, Call Dean at 505-322-7515. Okay, I'm going to hop into the news feed, but real quick, we're sitting on a 33% return in the high risk. The safe growth hit a 1.3% return in March, currently slightly down on the year, but everything's looking really good for both portfolios. Okay, so here's the news feed. Biden proposed $6 trillion budget for 2023. So there you go. That's what makes stocks go up. Market loves that. More debt, the better. Greek Fire 23 says, I view the market simplistically right now. The bond market has taken the Fed's word and priced in an aggressive battle to lower inflation. The equity market laughed at the 25 basis point hike and is buying beaten up tech as a hedge between slowing growth and the Fed not following through. So far, the conflict does not have any sort of diplomacy on the verge of being completed. And the G7 or the G20 does not like the idea of having to trade with R using their currency, which could be very good for oil. Jim Rickard says, thinking ahead to see what will happen when R completes its roll-up of U territory. I guess he's not a fan of this. Neither am I. Essentially, Jim Rickards, all the experts I know are really predicting this will end up with a surrender by U. And I think that is probably within the next 30 days. We will see. Alf says, when the Fed unveils their QT plan, remember these points: runoff or sales. If a runoff, watch the pace. If sales, watch for the duration risk being sold. The Treasury issuance strategy, what happens to reverse repo and the Treasury account. Plumbing is complex, short, easy narratives here. So in general, what we might expect with the May announcement is from the Fed is 50 basis point hike. I believe that will happen. They may delay the runoff of the balance sheet. I think they'll just slowly let it run off, but they've been talking about running off $1 trillion a year. Now, if they control which parts of the curve they're selling, they could potentially fix the bond yield curve, which would essentially mean dump all those long end treasuries to get interest rates up on the long end, which we'll look at in a moment. But for now, all they do is talk a big talk and then deliver very little, which was so far only 25 basis point, so 0.25 interest rate hike to fight 7.9% inflation, the highest we've seen in 40 years. Bank of Japan is massively printing money and buying an unlimited amount of their debt. The rumor is this is so they can essentially bring a lot of their manufacturing onshore and essentially start to decouple from China in terms of supply chains. So that's been very bullish for markets, more money printing. China continues to do these lockdowns with zero COVID policy. So again, this is going to keep that inflation running hot. Shanghai is the latest to go into a lockdown. We've got inverted yield curves all over the place. We'll take a look at that in a moment. I'm looking at what other critical headlines. But we've got a pretty straightforward strategy. Wait for this conflict to come to some sort of diplomacy, dump, boil, buy F and GU. That's really what I see coming down the pipeline. And we could talk about what might make us do the exact opposite of that. Essentially, if we start to pick on China, that's what would get me concerned about our current game plan. And so far, I'm not so sure that's in the cards because it would really cripple America. All right, you can see this yield curve continuing to get squished here. These interest rates are going straight up, preparing for all these interest rate hikes that the Fed promises they will do in the near future. Here's the 10 and 2-year yield curve. Currently 0.18, so just a small move lower. And this will finally have inverted. Now, if we zoom out, nothing to get freaked out about. This is actually very bullish for how we're positioned. It's when the long end steepens and the front end falls that we typically end up in the recession. And I believe it's because the interest rates on the long end catch up to inflation and everybody rushes into bonds. So we're nowhere near that moment in time yet. Okay, here's your yield curve. This has been the 3, 5, and 7-year have been trading above the 10-year interest rate. Okay, so what some people are expecting is that they might try to force the bond market's yield curve by selling bonds in certain parts of the yield curve. So we'll know more in May, but I'll just show you what they wish it looked like. And so if we go back to October of 2020, this is the shape of the yield curve the Federal Reserve would like to see, as well as banks. Okay, so nice steepening curve. Instead, we have a very inverted yield curve, screaming that there's going to be a policy error. Okay, so we'll see how this all plays out. For now, it's nothing for us to worry about on our end. Just note, it was about $3 trillion in stimulus that really made this go nasty. So Trump did $1 trillion right before he left office, and Biden did $2 trillion, and it created this insane inflation that's now led to conflicts all over the world. This is where we track the probability of rate hikes, and it looks almost certain there will be a 50 basis point rate hike in May, which I believe is already priced into the bond market. So I don't see this as anything to freak out about. This is where we look at the VIX futures term structure. It's currently in backwardation, so we're not set up for the VIX to skyrocket right now. In fact, the VIX has been getting crushed. Here's the reverse repo. This is another $1.7 trillion that could essentially be dumped into markets. This could be a very bullish impulse once this starts to dump, and it could also be a warning sign that interest rates may begin to rise. This chart, we're looking at our 3 favorite cryptocurrencies: Bitcoin in our safe growth strategy. We have Ethereum in our high risk strategy. If you do become a paid client, ask Dean about our private equity offering. And that's where we give you extreme exposure to Polygon, which is our most aggressive play. And you can see if we zoom out a little bit, it's outperformed Ethereum by nearly 10 times from this point right here. So when Ethereum was up 67%, Polygon was up 560%. And Polygon is essentially the Lightning Network for Ethereum. So if you know what the Lightning Network is for Bitcoin, Polygon has a very similar value add to Ethereum. And so we're getting ready, I believe, to see the altcoins start to outperform. In general, we like to see Bitcoin move up first, then Ethereum comes up second, and then all the smaller tokens come racing in right behind. So very exciting moves currently underway in the cryptocurrency space. Tesla's up 50% from its recent pullback. We like to compare Ethereum to Tesla. They've been relatively correlated. And this is saying there may be a huge, massive jump in Ethereum to catch up to Tesla based on this chart, about a 40% differential there. Irene says, if I had 100,000 to invest, do you still recommend 70 in safe and 30 in high risk? Yes, I like that combination. Absolutely. Okay, here's the TLT. And so the main takeaway here is for debt to grow, interest rates go lower over time. And the whole system is leveraged to about $300 trillion in debt. So my best guess is that the financial system would snap if the TLT were to quickly go below 125. 120 would be red alert. Anything below, I believe, would quickly create financial chaos globally. So that's our red line to get very defensive. Today we're at 129.82. And I believe the market's essentially priced in expensive energy and food for the next 3 to 6 months, as well as all these rate hikes. So I think there's very little that would upset the bond market to break into those levels anytime soon, but we're keeping a close eye on it. And so for now, it looks like this should be just about over and a relief rally coming into bonds, which means you want to be long those cryptocurrencies. Here's our two energy plays we like, BOIL and NRGU. And so BOIL's caught up to NRGU. We sold NRGU for a nice gain and rotated into BOIL. And I do think we'll be holding BOIL for a few more weeks, most likely, unless there's some sort of breakthrough in the conflict in Europe, which again does not seem to be moments away, to say the least. In fact, it might be nearing a inflection point where things really ramp up, and we'll want to be ready to take some profits there. Okay, now we're looking at lumber futures against the price of oil. Reason why is last May, we were able to watch lumber futures crash and predict an oil sell-off. So far, lumber futures are trading about halfway from its high and its recent low and not really giving us a clear signal. But I do believe once there's diplomacy, we should expect energy costs to oversell to the downside. And that'll be our call to go back long in RGU. Here's a look at DXY. In general, we're expecting the dollar to fall in value over time due to running twin deficits. We just hit a new record deficit in our trade balance, and we're about to run a massive $6 trillion spending package this year, or at least for 2023, if Biden's plan is accepted. So if we look at this period right here, after the dot-com crash to 2008, the DXY went from 120 to 72. Now, I'm not so sure we'll get that low, but my expectation is over the next 2 years, we will see DXY slowly but surely make its way to 90. And that's when I'll be doing a massive change of strategy for our portfolio. Now, if we look at emerging markets over that same period, I want you to note emerging markets had a 400% return while the S&P 500 had only a 67. So if you're in a safe growth strategy, you have a large emerging market position currently, which is what we're really getting excited for. This chart, we're looking at the Chinese yuan. If it's going down, it means the yuan is strengthening against the dollar. Now, the dollar's been going up for quite some time now. And so the only currency stronger than the dollar as of recently has been the Chinese yuan. Now, China is in an easing cycle as the US is in a tightening cycle. So they've got a very strong currency and can afford to expand credit. So it looks like we're gonna have Japan and China and maybe some surprises from Europe really being dovish with policy. So that'll keep the dollar stronger for longer, most likely. But again, we're still racking up massive gains, even with the strong dollar. This chart we have green is NRGU, that's the top 10 US oil and gas companies, times 3, so it's a leveraged product. We've got yellow, the triple T interest rates, and then we have the candlestick, the NASDAQ. What's remarkable is all three are going up. Typically, we don't see that. Now, in general, we typically expect if interest rates are rising, oil and gas goes up and tech companies fall. And so what we're seeing now is all three going up simultaneously. I believe this is primarily due to the Federal Reserve speakers indicating they're going to force bonds lower. And again, so that's just making everyone buy anything except bonds. And in general, we're expecting a global slowdown due to a lack of stimulus over the last year and a half, which means you want to be long your tech companies. Okay, in this chart, we're looking at Taiwan Semiconductors, Alibaba, and Tencent. And what I'm hoping to see for Safe Growth members is Alibaba and Tencent beginning to outperform Taiwan Semiconductors. And that's going to be our cue that China is done regulating tech and are going to start aggressively pumping their stock market up, because that's really the part of emerging markets that's been holding back their returns over the last year. And so you can see this massive sell-off in Alibaba compared to Taiwan Semiconductors. Now, if I zoom in, absolutely, we can see they are starting to outperform. So just in the last approximately 10 days, Alibaba has jumped 50%, Tencent 20, while Taiwan Semiconductors only jumped 4. So the gravy train for emerging markets may be departing soon, and we're excited to have exposure to that. Here's the European index. It's almost made back all of the conflict losses, and so now they're ramping up defense spending, and probably going to have to get a huge stimulus to we can't say the full word, Google's censoring everything these days, but I'm expecting the European area to have to ramp up debt and slow down the tightening policy to try to keep their economy alive. Russell 2000, we're not invested in any of our portfolios, but if it's crashing, we take alert. So far, trading in this new zone right here, it did fall from this zone to here, but seems to be regaining its lost returns and looking very strong. We're also long REMX and uranium, so rare earth metals and uranium in our safe growth strategy. And so rare earth metals are used for batteries for companies like Tesla and Apple, who need lithium and cobalt. And so we like that over copper for a better return. 3 years out, there's going to be massive shortages of lithium, almost certainly. So this is a very long-term play for us that we expect to hold for unless battery technology dramatically changes. This will be another very long-term hold like Ethereum for us. Furthermore, nuclear power is probably our only chance to get this carbon emission to zero by 2050 that all the elite like. So we like those two plays. We have used copper miners in the past as well, but at this point we like REMX the most. Next chart, we're looking at gold versus silver. And so right now it looks like there's a catch-up trade in silver over gold. I've been hesitant to go long gold or silver because there's 10 million job openings. And so I don't necessarily see the economy stagnating so much that we would have this 70s-like stagflation problem in our economy. So far we've not pulled the trigger on gold or silver and have taken Bitcoin or Ethereum over those plays. Now, this is probably the only chart that really matters this year. My expectation is for the core inflation rate to top out in March. So we'll get that data in the first 2 weeks of April. I think it's going to come in below 7. Now, this core inflation data excludes food and energy. The PCE is running at 7.9. So again, I'm expecting that food and energy costs will fall, that they won't stay at this elevated level, probably for more than the next, I'm going to stretch it. I think we could see elevated food and energy for probably the next 6 months, unfortunately, as a worst case scenario. So if that's the case, I'm going to expect this to hit 7 or below for March and then slowly drop. And this uncomfortable slow drop may wreak some havoc on the bond market. So we'll keep a close eye on those critical levels, which would change our strategy. Now, if the diplomacy in Europe happens sooner, those energy costs could fall. And then I'm actually expecting the core inflation rate to fall rapidly and cause a very dovish Fed surprise for the rest of the year. So in general, I'm expecting us to see the greatest returns in technology companies and cryptocurrencies over the next 12 months. For the previous 12 months, we were predicting the exact opposite. They make more money being long commodities. And that's why we've had such a huge position in NRGU and BOIL. So another thing I'm keeping a close eye on are new home sales. We've got interest rates in mortgages skyrocketing. So last time that caused a meltdown in markets The interest rates actually peaked 2 years before that that meltdown occurred in 2006, as you know, the great housing financial crisis of 2008. So far, lots of homes still selling, average prices over $500,000. There's very low inventory. And so far, I just do not see anything breaking apart. Retail sales are at all-time highs, massive amount of jobs. So this economy is looking red hot from my perspective. Okay, so very good. Now what we're going to do is go over exact trading allocations for both strategies and what our plans are. But if you're not paid, you don't get to see the end of the video. You need to call Dean now to upgrade at 505-322-7515. You're going to gain access to the membership area where you can punch in exactly how much money you want to invest, and our calculator will tell you what to buy and sell. And here's what it looks like.